All right, we'll begin with a quick introduction. Guardian Capital is a financial planning and investment advisory firm headquartered in Hyderabad, and we've been running since 2016. I'm Juveria Nooreen, a junior partner from the Family Office Services here at Guardian. I'm a chartered accountant by qualification and have worked at KPMG as an external auditor for 4 years before joining Guardian. And I'm quite excited to host the ESOP webinar this morning. Let's take a quick look at the index to understand what we'll be going through today throughout the webinar. First, we'll have a quick introduction on what exactly stock options are. We'll discuss the different types of stock options that are granted to employees. Then we'll look at ESOPs and RSUs a little deeper to understand the nature of both and the difference between the two. Then we'll look at the different stages in the process of from the stage of the ESOPs being granted to you as an employee, and then to the process of throughout exercising, and we'll discuss all the different stages, exercising of the stocks, and then finally selling them, or taking a call to hold them. And then we'll also look at the process of exercising the options. There's different there's quite a few stages in the process of exercising itself, where you would have to create a demat account for the stocks to be credited to you, etc. And then we'll finally get to the planning around ESOPs, where we'll cover the planning by discussing four different factors, which I'll talk about in detail when we get there. And finally, we'll close with a quick summarized model of the whole approach to planning the ESOPs. So I'll start with the introduction now. So over 20 years ago, the most significant component making up executive compensation was money, which was presented in the form of bonuses and salary, either of them or both. At this point, stock options and stock grants were a mere footnote. However, times have completely changed, and stock grants and stock options are now more frequently used than money when it comes to employee retention and executive compensation. Due to this, incentive stock options have become invaluable to businesses. Nonetheless, many individuals remain unaware of stock grants and stock options, which means that these incentive stock options can't be taken full advantage of as a part of investors' net worth, which usually ends up weighing a significant amount relative to your total net worth, leading to concentration of risk. This presentation is designed to offer the audience quality insight into the value of appropriate planning of your ESOPs or stock grants as part of your total net worth. Now, stock grants are broadly classified into two types based on the way that they are paid out. Under one category, you have ESOPs, RSUs, ESPPs, etc., where the stock itself is paid out as a grant. Now, under the second category, we see the SARs, or the stock appreciation rights, where the grant payout is in the nature of cash. We will largely be discussing ESOPs and RSUs in this presentation, as they're the most common type of grants across all employments. We'll begin with ESOPs. They stand for Employee Stock Option Plan, where the employee receives a right to purchase the stocks of their employer at a future date at a predetermined price called the exercise price. You'll find this in the grant letter received from your employer, the exercise price that is determined by your employer. These stock options will accumulate over the course of employment and can be sold at the time of retirement or termination of services, whichever is earlier. Now we'll look at RSUs. Here, you don't have a right to purchase, but the right to receive the stocks granted. After the vesting period, these stocks are directly credited to you after deduction of taxes. They vest at the fair market value assigned to the units, which in the case of listed companies would be the current market value, And in the case of unlisted companies, the value would be computed by the company's valuer. In case of RSUs, there is no exercise price, just a grant price, which is the fair market value of the stocks at the time of grant. Now, when a company provides an employee stock as part of its compensation, this stock is typically restricted. Any restricted stock has certain restrictions on how the employee and future owner of the stock may use it. Generally speaking, an employee of a company is required to hold on to this restricted stock for a specific time. When looking at the element of vesting in terms of employee stock, an employee doesn't have the right to do anything with the stock, even if this employee has earned the stock as part of their compensation. The employee can earns the right to sell the stock only when the stock has vested. Now we'll take a quick look at a few key terms, most of which we just discussed earlier. A term to take note of here would be the vesting period. This is simply the period that an employee would have to serve to earn the grant of the stocks. This is relevant for all types of employment stock grants. And I'll just quickly summarize everything that we've discussed so far. We've discussed what stock grants from employers are, the different types of grants in terms of payout, whether paid out in cash or in stocks itself. We have looked at ESOPs and we've looked at RSUs, where the former has an element of buying the stock from the employer. Now, let's take a look at the different stages in the granting of ESOPs. First, you're granted the stock options by your employer. Then, after serving the required period of employment, you earn the ownership or the right to purchase the stock options, which is when the options are said to have vested. Once you have the ownership, that is when you have exercised the options, you may then opt to sell the stocks basis their valuation. Now we'll quickly look at the process of claiming your stock options, or the process to exercise the ESOPs. First, a demat account will have to be created, and you submit the details of the same with your employer along with the exercise form that the employer would have shared with you. Post this, you will have to plan for the funding of the exercise. There are two different things that require funding. One is the payment of exercise price, and in case of ESOPs, that is. And the second is the tax, which we will talk about in detail shortly. The funding could be done either by way of loan, and there are ESOP specific loan options available across banks and various financial institutions, most of which are actually partnered with ESOP granting companies. So it would be a good idea to check with your employer if they have such a partnership. And the other way would be for the employer to hold some of the units back in lieu of the payment of both exercise price as well as the tax. So in this case, then you would not require any kind of funding because this will be done by way of the employer holding back units equivalent to the value of exercise price and the tax liability. And then post approval, your employer will allot the units to you, and they will finally be credited to your demat account. Now we come to the most important and interesting part of this presentation, the planning of your ESOPs as an investment in your portfolio and in consideration of your total net worth. Now, and this it is common across stock option grantees to have the stock options weigh almost 80% of their net worth. This level of concentration is quite a bit of a risk, which is why planning for the same is so essential. There are four basic important factors to consider when we begin the decision around what to do with ESOPs. We'll look at the first factor now, portfolio composition. Like I just mentioned earlier, ESOPs generally hold a significant weightage in an investor's portfolio. In an ideal portfolio, it is not recommended to have such a high concentration in just one or two investments, as the risk is not diversified. Now, the next emphasis is then put on the value at which the stocks are to be sold, both in comparison to the purchase price, which in this case would either be your exercise price or the grant price, and also relative to the earning capacity of the company. That would be the PE ratio. But that's a more a technical term that we would have to look in a deeper detail when actually planning for the ESOPs. Now comes an interesting one, the financial plan. It is basically an evaluation of your current financial position along with a strategy for funding your future financial goals with your current assets as well as your future income. So we take stock of your assets, your cash flows, that could be your salary, rental income, etc. And finally, link both of these with all your future goals. These could be, property purchase, children's education, etc. At Guardian, as part of the financial planning process, your current assets are linked to various goals basis their nature and duration. We'll quickly look at the asset linking to goals from one of our sample financial plans to understand this better. Here, if you look at the first goal, the contingency goal, in this plan requires a funding of 12 lakhs, which is required immediately. Hence, part of the um savings bank account balance of 37 lakhs is linked to the contingency goal. Whereas the ESOPs, being an equity investment, are linked to the retirement corpus goal. 27 lakhs of ESOPs to the retirement corpus goal of 1.47 crores in present value. Now, for the fourth factor, taxation. It is an inevitable cost that will be incurred in any case on the acquiring as well as the sale of your stocks. This is including as a deciding factor as it impacts the timing of your sale decision. There are two types of tax events that occur in our ESOP cycle. One is at the time of exercising the option and acquiring the stocks. In this case, you're taxed under salary income as the ESOP is a perquisite. The perquisite value is computed taking the difference of the fair market value at the time of exercise and the exercise price. Basically, the discount you're getting on the stocks for being an employee. The second event is on the sale of these stocks. A capital gains tax is incurred here, where the gains are simply the difference between the sale price and the fair market value that you were already taxed on earlier. Now, capital gains tax rates would differ basis the period of holding of the stocks. This period is computed from the date of exercise to the date of sale. Your RSUs, being equity in nature, will be taxed at 10% when held for more than 12 months, that's a year, with an exemption on the first 1 lakh of gains per year. When held for less than a year, the gains attract a tax liability of 15% with no exemption. I'll just quickly summarize the different factors we considered and we'll look at how they are relevant in our ESOP planning. Now, portfolio composition is evaluated by doing a current portfolio analysis. In the analysis, we judge the quality of the stocks, that is, the probability of returns from them. The ESOPs are an earning from your employer. Hence, you may be at risk of being sentimentally attached to your holdings. So, it's important to take an objective view on this by a third party, that is, an advisor. Another factor we look at the time of this analysis is the currency fluctuation element when your employer issues stocks of their foreign entity. We earlier saw the importance of assets linking to goals basis their duration and nature, hence the need of financial plan alignment. Now, it is imperative to track valuations of the stocks throughout to know when's a good time to liquidate the stocks. And the fourth factor, the tax factor, like I said earlier, is only important for the classification of your capital gains into long and short term, which is why a holding period analysis would be done. Now, I'll run you through the whole ESOP planning process in a short sample approach, considering all the factors we just discussed earlier. As part of the portfolio analysis, we first take a look at the quality of the stock, that is, the probability of returns from them. This is done based on research inputs on various factors such as revenue and earnings growth, for example. If the probability of returns from the stock is computed to be low, then we'll recommend to sell all your stocks, as there is no benefit in holding any, in keeping any of them. If the probability of returns from this stock is high, then we go to the next step where we will check your financial plan's dependence on the ESOPs. If your financial plan is significantly dependent on the ESOPs, this simply means that most of your goals are due to be funded only by way of ESOPs, leading to a risky financial state. In this case, we will evaluate the valuation of the stocks. That is, in case we see an overvaluation, then we will recommend to reduce the concentration to about 15 to 20%. In case we see that the stocks are fairly valued at that point in time or undervalued, then we'll consider reducing the exposure. We'll still consider reducing the exposure, but not too much. We'll keep it to 30 or 40% instead of trimming down almost all of your holding. Now, if you're lucky and your financial plan is not heavily dependent on the ESOPs, this means that the concentration risk of your portfolio is taken care of. And when we do the valuation analysis, we see that we have a fairly valued or an undervalued stock, then we will recommend staying fully invested. Even when we see an overvaluation, we can still consider keeping all the units in case the probability of returns is high, is computed to be high. Now I'll just quickly recap this whole decision tree, as it's a little complex to understand. So we'll just quickly run through it again. First, we will look at the composition of the portfolio. That is, understand the quality of the stock and the concentration of the stock in the total net worth. And this is done in two stages. First, the quality, where we judge the probability of returns from the stock. If we're expecting high returns, then we will look at the dependence of your financial plan on the ESOPs. In case your financial plan is highly dependent on the ESOPs, then we will have to do a valuation analysis where in either case, whether the stock is overvalued or fairly valued, we will consider trimming the concentration down. In case of overvaluation, we'll trim it down only by we'll trim it down by to 15 to 20%. Whereas when there's fair valuation or undervaluation, we will trim it down to 30 or 40% of exposure. And in case the quality of the stock is, that is, the probability of returns from the stock is low, then we will recommend selling all of your holdings in that specific company, that is your employer or ex-employer. And in case your dependence of financial plan on ESOPs is low, then there isn't much that you have to worry about. Your plan is taken care of, the concentration risk is taken care of, and in either case, whether there is overvaluation or undervaluation, you can consider holding on to all of your stocks, or you can consider trimming down a bit when there's overvaluation. So, and the stars at each step represent where Guardian Capital Services will or the advisory services will help you on those deciding points. So that's about it on the planning of ESOPs. Um, all the different stages that I mentioned earlier in the ESOP planning process are exactly the services that Guardian offers and can help with. A thorough portfolio analysis is done considering concentration, quality, and exit strategies. All this analysis including the computing of probability of returns, is done with the help of our dedicated research team from our asset management entity. Financial planning is definitely the core of our services. Investments are planned with in alignment with a quality financial plan. As part of the advisory services, all the operational aspects, such as managing timely advance tax payouts, as well as the advisory aspect of computing the minimum possible tax liability, is all managed by Guardian. In addition to this, we also do succession planning, insurance advisory. As part of succession planning, will help you set up trust or will basis the suitability to your situation. And not just all this, we also have a consolidated reporting system where we'll take stock of all your financial holdings, even the ones held outside Guardian, and report on their performance along with your financial plan to evaluate your goal achievement status. So we basically aim to be a one-stop solution for all of our clients' personal finance needs. We also have ready templates for the stock options cost calculation, where you'll just have to plug in your two or three values. That would be the exercise price, the fair market value, and you'll be able to see how much it's costing you in terms of tax, as well as the exercise price, the purchasing of the stocks. In case you would like to avail our services around your ESOPs planning, you may get in touch with us through our website, and one of our partners will reach out to you. Hope we were able to get you started with strategizing, your ESOPs as investments. Now I'll open the forum for questions. You can put your questions in the Q&A box. Any questions, anyone? Okay, so we have a question. If an unlisted company can issue RSUs, and they can, in fact, that's usually what's done, where just before listing, it's usually startup companies um, uh, issue ESOPs or RSUs to their employees, so that post listing the employees can benefit from the valuation gain of the stocks. I'll just keep the forum open, and uh, you can think through and put in your questions on the Q&A box. Okay, so we have a question. Um, I have some ESOPs. It's an unlisted company, and I need to pay around 40 to 50% of the book value of stocks in tax and exercise price. Will we be able to help, the person evaluate if the price quoted by the company is right? So, since it's an unlisted company, we wouldn't have access to their financials, and a lot of the information that we would need for in order to research and give an opinion on the on whether the price quoted by the company is fair or not. So that would be difficult, but we could basis whatever information we have access to, be able to help you understand if the pricing is fair, or if it's overpriced. In the case of a listed company, it would be quite easy, but in case of an unlisted company, due to lack of information, it'll be a little difficult. Okay, we have someone in the audience who has Amazon RSUs, which weigh around 20% of their net worth, and they're asking what they should do about them. So we'll have to take a look at your financial plan, and in case you don't already have a financial plan, we'll have to, we could think of, we could work around making one, and only then we'll be able to understand whether it would be beneficial for you to hold on to the stocks or to let go of them. So, but at an overall level, since it's the concentration is only about 20% of the net worth, um, it may be beneficial to hold on to the stocks, but then we'll also have to look at how much of your net worth is in liquid assets. If the balance 80% is all real estate, then in that case we would have to then consider diversifying your portfolio a bit. Will have to recommend you to exit some of the Amazon stocks, so that you can diversify your liquid portion of the liquid portion of your net worth. And we have another question. Have you, as a company, helped people with ESOPs in their portfolios? Yes, in fact, that's what drove us to do, motivated us to do a webinar on it, because we keep getting these questions around ESOP planning quite a bit with a lot of our clients. We've got clients who've got RSUs or ESOPs from Amazon, from Wells Fargo. We've got from Freshworks, etc. Okay, we have another question. I have ESOPs of US based company. Can you please explain me how to take credit of tax paid in US on those ESOPs while filing ITR? So there's a specific form that you would have to submit while filing your ITR on the portal, and we'll have to take this one on one. We'll help you. You can get in touch with us through the website, and you'll also find our email address and number on Paytm Insider, the platform where you've registered. Um, so we'll have to help. We've got an in-house tax team who will help you with the advisory, as well as the whole process of claiming credit on the tax paid in US on foreign on the US based employers stocks. um okay, thank you, no problem. Can we get a copy of the slides used? um think we'll be able to. I'll just have to check on whether we can. share material or content through the Paytm Insider platform. In case not, you can always reach out to us through the website. And when we have a one-on-one discussion, I'll be more than happy to share the slide deck with you. Right. Any other questions? Can a retail investor um, is a retail investor applicable to buy stocks of unlisted companies? If yes, what are the sources and how can we buy that? Yep, retail investors can purchase stocks of unlisted companies. Um, the sources and how we can buy that will have to discuss one on one. There's various different options available. We've got funds who specifically invest in unlisted companies, and also there's different options to invest in unlisted companies directly, not by way of a fund. But I mean, that would depend on like what kind of companies you want to invest in, so we'll have to take a look at that, and we'll be happy to help you out with it.